Oh, we're taking video now. So for the first time, we're also going to do this on video and get it to the website. And again, I want to thank all of you for tuning in. We're going to give people about another minute here. If you could, just to make it easier until we open for questions, if you could just mute your phones while I do a short presentation. You got about a minute here, and then we're going to get going.
Has joined the conference.
Stephanie
has joined the conference.
All right, again, I'm going to thank everybody for joining us on our 2020 review and 2021 outlook. We call it Perspectives. I'm here at the office. We're going to do this on video and post it to the website as well. So again, thank you for joining us. Thanks, first of all, to our clients who we appreciate the trust that you've placed with us, and we don't take that lightly. And without you, we wouldn't be here. I also want to thank our team here at Vista, Olivia, CJ, Kim. You guys are awesome. I would not want to do this without you, and well, maybe I just couldn't do this without you. So thank you guys, and thanks to our partners at Vista, Indiana, Brett, Sarah, Stacia, Matt, and the rest of the crew. We have a great team in Indiana as well. So without further ado, 2020 in hindsight perspectives. And the first thing I want to comment about 2020, for many of you who heard me through the year and all of you who have experienced it, 2020 was anything but typical. The index at the end of the year read up 10%. That's the S&P 500 equal weight index. And that told very little of the story. The cap weighted index was up 16%. The Russell 2000 up 18%. We use the equal weight S&P 500 because the cap weighted index is heavily weighted to technology. Many people are familiar with the FANG stocks: Facebook, Amazon, Netflix, Google, Microsoft, Apple. Those 6 stocks on the cap weighted index represent something like 27, 28% of the of the index. And the other reason that we like the equal weight is I think that the techs are a bit overvalued, particularly those names I just mentioned. And I am fortunate enough to have been around long enough to experience the tech bubble of 2000.
Has joined the conference.
Olivia or CJ, when they're coming in, we're hearing everybody's name announced. Not anything to do with it. Okay. I can't mute it because it's recording. Okay, got it. So without any further ado, we're going to talk a little bit about interest rates. The pandemic of last year was a huge game changer for interest rates. In fact, back in March of this year, when the pandemic began, the Fed essentially took interest rates to zero. And we announced in the U.S. a huge stimulus of $1.6 trillion. And the Fed began pumping money into the system due to due to the COVID virus. And what the Fed told us then and was unprecedented was exactly what they intended to do with interest rates. They essentially gave us their playbook, and that was they intended to keep interest rates.
Reggie Brunner.
The current interest rate stands for the foreseeable future until inflation tops 2%. So the interest rate market, bonds rallied tremendously. Interest rates went to zero, and the pandemic began in March of last year. Gold was soared then. We saw crude oil when we had the shelter in place. We saw crude oil go to a minus $15, and I never thought I would see crude oil below the 1986 lows, which was a print of 1055, and we actually saw it below that. We saw dollar weakness through the year, which is not a bad thing for the U.S. economy. It makes our exports look more attractive overseas. And oh, by the way, there was an election last year, as some of you may have noticed. So it was an event-filled year. In fact, just on a tactical basis, we were up early in the year between 7 and 8%, then we dropped 35%, then we rallied 35%. In the middle of that rally, we had a 9% correction, a 9% rally, another 9% correction, another 9% rallied, and then we finished the year plus 10%. In other words, the market moved around 130% to get to that plus 10% on the year. There's no time in history when we've seen that kind of volatility in the stock market. The upside of this is that the stance the Fed took and the Secretary of Treasury adding liquidity to the system kept a severe recession from becoming something more. And their actions back in March actually marked the low for the market, and the market began climbing its way back and finally to exceed the all-time highs. So quite an eventful year. We did a mid-year update, and I was looking into the fall and saying it was going to continue to be bumpy. We saw two between 8 and 9% pullbacks, one in September and one in October. And then we had the election coming up in early November. Our seasonal entry that most of you know about proved to be a great entry for the market. I was concerned about it with the election coming. But as it turns out that the market continued to rally post-election and really has rallied all the way through today on the 4th of February in 2021. The unprecedented thing we saw last year was not just our Fed stimulus, but global stimulus of over $6 trillion around the globe. And essentially what that has done is it has inflated the economies so that they weathered this storm of the pandemic. Now, I said weathered very poignantly. I believe that the pandemic is on the downhill side as we continue vaccinations and get herd immunity. I think by late in the second quarter, the pandemic isn't going to be a distant thought, but it's going to be really on the way out. Another interesting thing that happened in all of this that is sort of unprecedented. The Fed has given us the playbook for the U.S. economy. They have said that they're going to keep interest rates near zero on the short end through the end of 21 and into 22, and they really don't see rates going up until 23. Now, the reason that that's so important is when you put that much liquidity into a global economy, we should see expansion. And I want to talk a little bit about the market, what we're going to expect this year. This year is the first year of a presidential cycle, a new administration in the White House. That has typically been a tough year for the market. You could read that to be up single digits, maybe mid to upper single digits, but I think that a lot of the recovery has been discounted into the market. So I wouldn't be shocked to see some short-term volatility in the market. Again, when the Fed gives us the playbook, though, on these declines, we want to be buyers because we know that this stimulus and the longer term outlook for the market is good. If you think back to the last recession where unemployment peaked a little over 10%, we saw unemployment at 16% in this recession. And by the way, in my view, the recession is ending now. It may end up technically ending at the end of the first quarter or even in the second quarter of the year, but the recession is pretty much over as we start seeing, again, the vaccinations being distributed over 1 million a day at this point, way higher than the new case count, which is yesterday was 123,000 or something of that nature. So we want to be aware that the Fed's given us their playbook, and so the key to recessions ending is money being easy to find, and then the next recession will come when credit is tight. So that is the reason that recessions happen is credit is tight and money needed for expansion is harder to find, and thus we go into a recession. That is not the case we have here today. Again, I keep saying the Fed's given us their playbook. I'm going to continue on that mantra. I don't think we're going to see much change in interest rates on the short term. Longer rates go up, and for those in the business like me, what we're looking at is a re-steepening of the yield curve, which means the difference between short-term rates and long-term rates is going to expand. And that is a very healthy sign after a recession. It means there's demand for credit is available. And so we're already seeing that happen. That spread got down in the 20 basis points. We're back about 110, 115, something like that in the spread. So for this year, interest rates stay pretty flat. We'll see the long end come up a little bit in our bond strategies. That'll help us with some yields in the intermediate term. I mentioned this, but again, I think that somewhere in the mid single digits to upper single digits is the return we'll see by the end of the year. As most of you know, there's more stimulus coming. Currently proposed in the House and the Senate, 1.9 trillion proposed. The Republicans have countered with 600 billion. We're going to get more stimulus. A year ago, I said that I thought rates would eventually get to 57, or actually, one a year ago was last summer. And I told a couple clients this: if I were a baseball player, I would be dropping the bat and trotting around the bases. My long-term projections for crude oil are considerably higher than it is now, which I'm not even going to give you a number because it kind of makes it not seem real. And I want to talk a little bit about the strategies we run. We here at Vista have 4 growth strategies that we run on a client-wide basis. The 2 stock strategies, the investing for growth strategy that last year was up 1.79, and the GRIN strategy, which was up 402. They both trailed the S&P last year. It was the first time we underperformed in 9 years. I kind of feel like Tom Brady. We finally underperformed last year and probably got traded by a few people, and we anticipate being back in the Super Bowl. The last time we underperformed was 2011, so we had 8 straight years of our growth strategy outperforming. The growth income strategy is kind of designed to be a little bit less return, less risk. So we kind of anticipate that it's not going to outperform the S&P. So let's talk about what really drives those strategies. Is we like to monitor earnings estimate revisions with analysts. The last 3 quarters, we have seen U.S. companies exceed analyst expectations dramatically, both on earnings and on revenue. And had you told me that back in March of this year, I would not have believed it. But U.S. corporations have been incredibly good at adapting to a very difficult situation. And so we're very impressed with U.S. corporations as a whole. We have more stocks eligible in our strategies than normal. That means it's a very broad recovery. Vista is earnings driven, so we'll continue to do that. We have seen this quarter be a little hard, even on those companies beating earnings estimates. This quarter there is, and this quarter being the reporting for the 4th quarter of last year. Right now, about 75% done. Earnings have surpassed estimates by 17.3% in aggregate, with 80% of companies beating their projections. And we're actually going to see revenue growth year over year for most of the S&P 500 companies. They're going to see earnings growth and earnings per share growth as well. So I'm just amazed at how well companies have adapted. I think there's some pent-up demand, though, because travel's not back to where it was, and spending is not quite where it was. But that's going to come over time. In the last recession, one of the pieces that I talked about a lot is that once unemployment peaks and starts to go down, when we get to full employment is when we're at the most risk for a recession. So we're quite a ways from that right now at about 6.7% unemployment. So there's that. And so I still think that pullbacks of the more significant nature, more in the 7 to 9% range, are places that we can add to positions. I think earnings comparisons are going to get harder in the second half of the year because of how well U.S. companies have done this year. But I do think that we have one more quarter where we're going to look pretty strong versus last year's numbers, which should be this first quarter, because the pandemic didn't begin until in March, and so that hurt last year's first quarter numbers. So this year should be a pretty good first quarter. The keynotes going forward that we're talking with clients about is we want to pay attention to the Fed as long as they're not raising rates I think that we're in a healthy environment for the growth investing. We do think the rates are going to get increased probably mid to late 22 or early 2023. And with that, I'm going to open it up to questions. And if you if you'll say your name and then ask the question, I'll try to recognize you because there's quite a few on the call today. Anybody, any questions?
Hey, Ron, this is Reggie Bronner.
Hey, Reggie.
How you doing? Question about, the most recent volatility in the market with the Reddit deal and all that. Does that change your strategy at all as far as investing is concerned? Or you still just looking at earnings?
Yeah, no, we got some of that on the nose the last couple of days. I'm really not supposed to talk about individual stocks, but we have a company that reported earnings. They had a blowout quarter, and it was up $15 a day before yesterday, and then with no news on it, down $15 the following day. I'm not going to say that was the same culprit, but I believe that this is where we need some regulation. And I'm getting a bit older, and I sound like an older guy. We used to have what was called the uptick rule. You couldn't short a stock unless it was on an uptick, which kind of takes computers out of it. I'm sure they'll figure a way around it. But I think there's some things that they need to do to curb some of this trading that's going on with the Reddits of the world, because people will get financially hurt in that. And so my 2 cents, I think that's something we really need we need some legislation on. So if you're not done screaming at Washington, tell them to address these kind of issues that makes the market more stable.
It doesn't necessarily change your strategies, though, as far as investing, right?
Yeah, I'm kind of a simple guy, Reggie. I like owning companies that are doing better than they expected, and we just stay with them. As long as earnings are going the right direction, I don't worry that much about day-to-day changes in stock prices. I'm aware of where we are relative to indexes, but kind of like Warren Buffett, I mean, I think eventually earnings are going to win.
All right. Okay, makes sense. Thank you.
Thank you.
Ron, do you hear me?
Yes, sir.
This is Tom Youth in Indiana. Couple questions really around one question around the change in administrations. Are you expecting any changes in the sort of the landscape of, what companies or industries to be looking into based on the priorities of the new administration? For instance, besides the almost $2 billion that's being talked about for economic stimulus, there's actually about a matching amount that's going to go into green energy, as an example. But there will probably also be changes in the regulatory regime around all kinds of things. And in addition to that, there may be moves on the tax front, whether it's capital gains changes or even personal income tax changes. And I just wonder if you anticipate what that will do to the way you look at the stocks that meet your qualifications for inclusion in the portfolio.
Great question. So the answer is one of the older influences on our asset management is what we call the presidential cycle, which I mentioned early in the call briefly. And the first year of an administration is typically the worst because the market is adjusting to the new policy. So by nature of those changes in policy, companies begin to change to acclimate to it. And we own what we feel like are the best of the best, the companies that are doing the best in the current environment, which is often the very strong management companies that are going to manage these situations the best. When we looked back at the last 3 quarters and how much industry exceeded expectations, the governance and management of U.S. corporations has done a phenomenal job in this recession, and so we feel like we're with strong management teams because they're exceeding expectations, and it's very hard to get on the list of companies that we select from. So as a result of that, we think that they're discounting already what's going to occur under the new administration. You have to know that these companies were thinking about political changes not in early November, but a year before that. And so many of them have already adapted to the changes. So we think that that's it's already an innate part of the process that we go through. Great question. Oh, and by the way, I've shared this analogy a lot of times. If you think of the last recession and the election in 2008, we elected a new president, President Obama, and he came in similar with Mr. Biden, and we anticipated higher taxes, all that kind of thing. And during the Obama administration, the first 8 years were the first 8 years of the longest expansion in history, which lasted 11 years. It ended in March of 2020. So what we anticipate is we're going to have a bit higher taxes, which is a drain on growth. It doesn't eliminate growth. The best guesstimate I have for that tax burden on the S&P 500 earnings is about $4 or $5. Companies are going to offset that with dramatically lower interest expense. I get a lot of questions about the amount of debt that's going to be out there for the U.S. government, but the interest on that debt is actually at 4 and 5 year lows because of where rates are. So even though we have more debt outstanding, it's more affordable at the current interest rate. So some things that I think are going to come into the picture is when rates go up, that's going to be more problematic, and that'll act as a brake on the economy. So it's kind of interesting. Great question. Thank you. Other questions?
Ron, Brett Guiley in Richmond, Indiana. As we go through our monthly research and look at the companies that are eligible, are there any sector themes that you're seeing that may be coming to the forefront for the economy?
Yeah, and thanks, Brett Guiley. I should introduce, this is Brett Guiley, our managing partner in the Richmond, Indiana office. So he's asking a question that we just did research here at the first of the month, and I've been combing the research to find the companies that we want to own. And what I see coming up a lot lately, Brett, as we've discussed a little, I keep seeing financial stocks show up, which is indicative of a rising spread between short and long rates. When rates are going up, financial institutions do well because they can charge more on the loans they make, and then therefore they have more revenue. But they're borrowing that money from the Fed at almost 0%. So the financials are showing up right now. We've had industrials in there. They have done well. They're getting a little tired, but I don't think they're done yet. Those are the ones that I see right now. I suspect we're going to see more consumer discretionary names come out in the latter part of the year, but we'll wait and see about that. Brett, since you're on, let me ask you a question. What concerns do you have right now in the U.S. economy?
I think that given all the stimulus here in the call, and the fact that we have the stock market near all-time highs and interest rates near all-time lows, the thing that kind of keeps me up and worried a little bit is the impending inflation that we're seeing. And it may not be in the consumer price index yet, but I think anybody that has gone shopping for a new automobile recently, priced a construction project, gone to the grocery store, even to the gas station and filled up their automobile, there's inflation in this economy because there's a lot of excess liquidity and pent-up demand for travel, as you mentioned. And so I see those prices and supply and demand really causing, especially people on fixed income, some heartburn when their CDs and bonds come due, trying to get those at better rates to put coupons and put money in the bank for these expenditures.
Yeah, great point, and I totally agree with Brett. We're going to pay attention to these inflation numbers, and even though it isn't showing up yet in the CPI, we want to pay attention to them because when the Fed starts tightening, it's going to change the landscape in the growth side of the portfolio. We're already seeing rates higher on the intermediate bonds that we're adding to the latter portfolios. They're not dramatically higher yet, but we're seeing them trickle higher as bonds sell off and rates go up a bit. Great question. Anything else that's on your mind, Brett?
I think that an interesting thing is starting to occur with investors that I've had meetings with, clients that we've had meetings with. It seems that there's an appetite for risk, especially when you're under a certain age right now, given the recent market strength. And those that maybe have been around a little while longer and have seen a couple recessionary periods seem to want to pump the brakes a little bit and hold a little bit more cash, get a little more conservative. So I think that's an interesting dynamic and kind of feeds into what we're seeing with the Reddit hype and some of the items that are alternative investments out there right now.
Great comments. Let's do a quick run through with the client side. Any other client or phone participant questions for Brett or for I?
Yeah, Ron, John Marshall. I was walking through Penn Square yesterday, and half the stores were boarded up, papered up, at least. And I just took a quick beeline from the parking lot to Godiva, which, by the way, is closing down too. And I was curious if brick and mortar and commercial real estate is going to take a big hit after we recover from this pandemic, and what your thoughts are on investing in those areas, or should they be avoided? Thanks.
Well, great question, and you have to be very specific. We were very fortunate during the pandemic that we had some retailers, which, if you think about it, sounded like a terrible place to be when they shut everything down. And this is not why we bought them, but again, to one of the questions earlier in the call, we own well-run companies like Burlington Coat Factory, Home Depot, and their online business grew exponentially during the pandemic. So some of the better companies are handling it much better than some of the smaller companies. And we think that'll continue to be the case. I don't think brick and mortar is done. I think late this year we'll see another run in the brick and mortar stores. Um, I think people would prefer to go out and do the shopping in person. But I think there was enough fear during the pandemic that they'd rather have Amazon delivered to their door. And so my concern as we get to a more normal society where we're able to move out and go places, this is one of the reasons I think the tech area may underperform going forward because, when I'm in the house and I can't go anywhere else, of course I want all the technology I can have to maneuver and, entertain myself. But as soon as I can get out again and go to the mall or this or that, I think people are going to go away from that technology and go back to brick and mortar. I think it has changed. And by the way, John, when we first had the internet and in the dot-com bubble that I alluded to earlier, they were predicting the death of brick and mortar back in the late 90s. And the internet was going to be the thing, and that's how they justified ridiculous P's and such with tech stocks. And a lot of those companies, or a few of those companies, have survived. So I think it's going to change what we do. I don't think it's going to eliminate brick and mortar in any stretch of the imagination. We've come through a lifetime event in this pandemic. This is not likely to, happen again every other year. This was a major thing, and I think that it's going to make the health system better, and I think we'll be able to handle this better in the future. So, great question.
Okay, thank you.
Okay, so we're about 35 minutes into it. I'm going to open for one more question, and then, as always, I encourage you to call Brett in the Indiana office and me here in Oklahoma. Any other questions from the call-in side? All right.
Ron,
Yeah.
Tom Heath again in Richmond, and maybe I could add a little color commentary to the question of the pandemic effect on things going forward. And I don't disagree substantially with your shorthand version of the way you described it. It could be exactly that way, and I think that's the likeliest scenario. But I think that there are some, and I'll just tell you from I have a position of some expertise. I'm a physician and administrator in the health system locally here, and basically my job 24/7 for the last 10 months has been 11 months, almost 12 months now has been pandemic completely. And I think there may be a couple of wild cards that could maybe change, maybe the timelines on recovery from the pandemic. And the one big one is just sort of the interplay between some factors around reaching herd immunity. And one of those is the pace of vaccine rollout has not, if you've been paying attention, you will know that it has not been living up to the early expectations from Operation Warp Speed. Virtually all of the vaccine manufacturers are encountering difficulties keeping up their production schedules, finding all kinds of problems in their own supply chains and so forth. Just as one example, Moderna isn't able to source enough vials and transport media for their vaccine, and so they have actually requested of the FDA approval to use a slightly larger vial that'll have 15 doses in it instead of 10, as an example. And that's their way of trying to get more vaccine. They're able to make a vaccine. It's getting it distributed, starting with the the packaging components basically is an issue for them right now. But that's only one example of problems that virtually all the vaccine makers are having now. And that's a problem generally because we know that the virus is mutating, and with further mutations, the new versions are going to kind of slip away from the efficacy of the vaccine. And so there's this balance of how quickly can you get enough people vaccinated to really kind of stop the virus before it mutates to a version that requires more boosters and more vaccinations and so forth. And then you throw into that mix the problems with vaccine hesitancy, which affects really a large portion of the population. Not as much in the older age groups, but certainly is a huge factor in younger age groups, which are actually kind of key to getting vaccinated to stop the spread between them. And they tend to have fewer symptoms and have a hard time seeing the value of vaccine. And then there are all kinds of myths and concerns, particularly in. Are you guys still there?
Yeah.
Okay, sorry. My phone down. I thought it hung up. So, and then one other thing to keep in mind is that with large worldwide pandemics, which we don't have a lot of experience with, the last big one truly was the 1918 Spanish flu pandemic. That actually was a series of waves over several years, which is how we got to 50 million deaths worldwide. And yes, the U.S. and world rates are improving now. There are some hotspots in Brazil and other places. But I think we don't know for sure what the next wave is going to look like, what that will be like. And so if there are more waves, if we have trouble keeping up with vaccine production, if vaccine-resistant mutations emerge, these are all sort of wild cards that may have an impact on with a lot of reverberations through the economy, with things like having to continue to restrict travel and people having to stay home. And so I think I'm having trouble sort of anticipating what's going to happen this year, except we hope it will continue to improve. But there are many unknowns in the whole thing.
Well, first of all, thank you for your work in the field with this pandemic, and we certainly appreciate your efforts, and we have a number of clients that are very, on the front lines as well. My significant other's helping do the vaccinations, so I appreciate your comments, your concerns, and your service to the community. So yes, you're right. We don't know exactly how it's going to play out, but what I'm impressed with is the medical community's ability to adapt and change and develop vaccines in a extremely quick way. Because if you think about it, a year ago at this time, we were just hearing hints of this. It wasn't even a real event yet. So my applause to the medical community. And so with that, we've run out of time. Thank you for your questions. As always, feel free to call Brett in our Indiana office or me here in Oklahoma City if you have any specific questions about tactically what we're doing with the market. And just a quick aside, I did talk about our 2 equity strategies. We also have 2 mutual fund strategies that did very well last year. So we hope you have exposure to all of those. Again, thank you to the clients. Without you, we wouldn't be here. And we'll join you in July, Brett and I. Thank you. We got a doctor on and he got